Let's move on to another key to success, and this is a big one: position and money management. The best technical analysis and strategies are not going to make you money in the long run without money management rules, and they have to be enforced rigidly. So I think you already know this, but a 50% loss in your account requires a 100% gain to break even with the money that's left. It's a big point to recognize, and why money management is so important, that you take calculated risks as a major key to your success. This is a business. It's not a hobby. If this is entertainment for you, well, that's all well and good, but still no reason to be risking more money than you should. Do it intelligently. And I do have subscribers that call and tell me that they enjoy doing some trades and credit spreads because they're retired and keeps them busy and something to do. That's fine. But don't be looking to swing over the fences. This is such a big key, and I can tell you from experience, it's one of the ones that the majorities just pay attention to last. The technical analysis part is certainly more interesting. It's what will make you money when you understand it and do it correctly. But without the money management part, odds are you're going to lose big at some point and you're not going to make it. So this is how most approach it at the beginning, meaning I'll just buy 1,000 shares per trade, or 2,000, whatever it might be. Or are you going to risk $1,000 per trade? And as you start to look at money management closer and start thinking that, hey, this isn't gambling, and I'm doing this intelligently and taking calculated risks, I think, well, maybe I'll risk 1%, a half of 1% of my account per trade. And as you take it further, I'll risk 1/4% per trade and 1% of my account per day based on Master Trader Strategies plan. Now we're getting smarter, and the calculated risks are just that, more calculating. So let's talk about how doing it. Well, the first thing to do is determine the amount of risk, dollars, we're willing to risk per trade. So we refer to that as R for short. Now, with consistent losses, and obviously the goal here isn't to be consistently having losses, but the goal is to have losses, the amount that you do lose in losing trades, to be consistent. And by doing that, having calculated risks or losses, you're never going to blow up your account in 1 or 2 trades. As swing traders, by definition, we are holding positions overnight, which does come with that overnight risk. And I did mention in a prior section that I don't trade biotech stocks, but do trade biotech ETFs. One of the reasons is that the overnight risk can be sizable. Yes, it can be this other way, with the upside being huge as well. But biotech stocks with a bad report on a particular drug can gap down 30 to 50%, and I just not willing to take that calculated risk. So I don't trade them. Can other stocks gap down significantly? Of course. But that's primarily related to earnings when they come out and they disappoint. We know when earnings are coming out. So we choose, if you not to hold over earnings, that's a way of eliminating that risk. If you're holding a position longer term, which isn't swing trading, and you're holding on, there are different option strategies that you can use to control risk and increase, or I should say decrease, your cost covered calls. Different option strategies can be used for longer term positions. It's about planning. You determine the amount of risk per trade, per day, per week. And psychology is so connected to this, in that when you use proper money management, I can't tell you that there's no stress, because there's always some element of stress because of the unknown that comes with trading. Whether it's day trading or swing trading, we don't know how the next bar is going to form. But when we're taking calculated risks that are acceptable to our account size, that stress is reduced exponentially. So how much are you willing to risk? What's your maximum amount of money that you can lose on a single trade? $10, $50, $300, $1,000. You might say, Greg, $10 is ridiculous. I have had students that have blown up their accounts, accumulated small amounts of money, and started over again with $10 risks and eventually became successful. So even if $10 or $50 means nothing to you, realize that you're in the learning process and just make the trading about getting experience and assimilating the information that you've learned here, and take the money part out of it. And eventually, as you gain that confidence and discipline and patience in yourself, then you start increasing your risk based on your account size. But in the beginning, make the money meaningless. Here's a example of a table that you could use for calculating your risk, where you might say, I have a $100,000 account, and I'm going to risk 0.5% of that capital, and my maximum loss per trade is $300. So $300 times 4 losses in a day, $1,200. 4 losses, I don't trade anymore. We're done. And so we need to calculate that size based on the stop loss. And in this table, you can see how the smaller stop loss allows me to increase the share size. So in the middle there, based on 40 cents divided by 300 shares, it's 750 shares. So with that being said, you take whatever it is that you're going to risk based on your stop loss. And now you can say, with different trades, this trade has a 70-cent stop. This one has a 20-cent stop. Maybe it's got a $2 stop, as a swing trader, especially with stocks that are $75, $100, maybe $150 a share, and they have those bigger stops. You doing less shares, and don't shy away from those stocks that are $100 or $150 because you're doing less shares. Why? Because they have the potential to move for $5, $6, $7. So smaller share size can add up to a lot of money in those higher price stocks. Now we want to determine the risk based on the chart. So while we're saying that our stop loss is going to be based on a technical chart pattern, meaning here is my entry point above the red line, which is the high of that green bar, and our stop is below. If for reasons being maybe the pattern, such as this one, as it's shown, and we talked about this in the prior section, where the bars came down with lower high, lower low bars, and we talked about how prices came down in a smaller time frame, that it would be trending, right? We talked about that in a smaller time frame. It's trending, and while I love this pattern as far as a wider range bottoming tail bar, and if it had an inside bar the next day, I would like it even more because of the explanation of that sideways consolidation on the lower time frame, and those time frames coming into alignment, and then the trigger. Great. And now putting the stop below here makes absolute sense. However, let's assume that the pattern is one in which it's just as it exists right now, or maybe even it doesn't have this bottoming tail bar, and it just got this 2-bar 180 type of reversal. Well, at that point, I might consider a bigger stop and saying, you know what? Well, 15 cents sounds great, and more shares to make more money to target. Well, maybe under a certain condition, based on the pattern, the market environment, whatever it might be, I'm deciding to double my stop loss and reducing my share size. And because at that point, maybe it wiggles and I'm still okay, and I'm sitting through that because the major trend is up and it's above major support. So that's a decision that you'll make as time goes on based on the patterns that you see in market environment, or just you're in a learning process and you're saying, well, you know what, I'm going to give this thing a whole bunch of room and see what it does, and I'm going to do 60-cent stop with 500 shares, and let's just see what happens here. And if it pulls back to this point, no big deal, and then we could observe to see what it does, and so on. Oh, reviewing what we've already talked about and what we see here on this particular stock with these moving averages the way they are, well, here's an example of the 20 MA intersecting through the middle of prices. I'm not interested at that moment in time. However, looking at what's happening bar by bar, I can see that this is in a bottoming process above its 200-day moving average. And we're always looking for what I would call an event. What's an event? It is a bar that occurs within the context of what preceded it that says this is a moment in time that's key and that prices are likely to start moving for reasons of that event. And in this case, there was this bottoming tail bar that was a big red wide range bar. So a range expansion bottoming tail bar. Those are powerful. We covered that in the candle section. And so this is where prices are just starting to turn up again, and it's the beginning of a move. And I like this pattern. And as it says, 99% of our entries are going to trigger by trading above a prior bar's high. Now, with that being said, if I was to see a very compelling pattern, such as this, with a range expansion bottoming tail bar, I might decide to put on an initial position at the close of trading, or very close to the close of trading, where I know that that bar is going to close that way because we're near the end of the day. And I'm going to hold that overnight, and I'm going to give it room. And initially, our stop would certainly be below the low of the bottoming tail bar. But because it hasn't triggered yet, maybe I would increase the stop loss a bit and take on even less shares. That is certainly a choice. But this is a very attractive pattern. And looking at the pattern, say, well, and this is a question that often comes up, so why I'm saying it is, it'll often be asked, do I have to wait for it to take out that high? No, you don't. And the reason being is because this pattern is one that says that high is going to be taken out. So you don't have to wait for that. You'd be having a bigger stop, and we've already got enough information that says prices should go up. So when we buy pullbacks within an uptrend, and this isn't an uptrend yet, but it's a pattern that says it's going to start moving up, the assumption is that it's going to take out the prior swing high. This isn't a swing high, but the pattern is one that says the high is going to get taken out. And even if it's not taken out immediately, and as you can see, it wasn't, our stop is down here. So whatever happens, and it could have been another bar here, and then it eventually went up, we really don't know how it's going to play out. But we look at the overall pattern with the concepts that we've covered, and we make an educated assumption about what's likely to happen. And in this case, we had a big rounding bottom. You could look at it bar by bar, and this event that happened right there says it's going to go up, and our assumption would be it's going to come up to there, and then we would trail, and that's what we're going to talk about next, about how to trail this as it begins to move. So once you've gotten into a position, clearly we would like to make as big a gain as possible. But to do that, we're going to have to let prices correct, meaning at times we're going to have a profit where if we would have closed the trade out, we'd have had that money. But our assumption is that based on the pattern and bigger picture analysis, that prices have the potential to move even higher, so we're going to have to let it wiggle. We don't know the extent of the correction, so we're going to have to give back some of the gains not literally giving them back to where they're gone. The assumption is that what we could have taken, we're not, and we're just going to let it correct a bit, and it's going to move higher. So we don't know what's going to happen, and there's just no way around that point because none of us know the future. So if the stock hasn't reached an area of supply, resistance, or demand yet in a downtrend, the odds are with you. How are you going to do it objectively? Well, we're going to do it in a very systematic way. So our first reference point of demand or support in a long position is a prior bar's low. And from there, we're going to see if it forms a pivot. So that second reference point of support or demand in a long position is the prior pivot low, or that swing low, as we've defined already what that is. So if we're long and there's a price void, we're going to hold on to part of that position even if it violates a prior bar's low. Now, at the beginning of a move, right, we don't want to stop out under a prior bar's low immediately because that just wouldn't make sense. Prices haven't really started to move yet, and the pattern hasn't developed enough yet. However, if we get into a position and it just accelerates higher immediately, let's say it goes up 3 days in a row, 4 days in a row, that's fabulous. So if that was to happen, well, it'd be okay to sell half below a prior bar's low, and then we're just going to let it pull back and pivot and go into what I would call intelligent hope mode, which means I hope it doesn't go all the way back down to my entry point and that demand is strong enough to where it can create some support and prices wiggle around, maybe they pull back a bit, and then they overcome that prior swing high, and now it's formed a new pivot, or what we refer to as major support, and then we'll bring our stop up below that prior swing low. So once that's happened, we're then letting it move, and as long as it doesn't go below that, and then we're going to just, ideally, it's either going to accelerate higher or it'll move higher and then pivot again where we can bring it up under the next pivot, and then if it does accelerate, we'll then begin to trail stop under a prior bar's low again. Here's an example of exactly what I just said, where we're getting into a position, right? So there's your entry point, and we're assuming it was in an uptrend, let's say at the 20 MA, and we've entered, and prices accelerate higher, bar by bar, very nicely. So we bring our stop under a prior bar's low. For half of the position, you may decide that you're going to sell a third of the position based on multiple time frame analysis and a price void, and maybe the markets have just come out of a bottoming process, and we haven't talked market internals yet, but they've just given you a recent buy signal, so maybe you decide you're going to only sell a third. You'll decide that at the time. And then prices pull back, and you get a pivot, as we've defined, a pivot, 3 higher low bars to the left and the right, and then it overcomes the prior swing high. So now your stop has gone here, and now you're just waiting to let it pivot again. And as it reaches closer to your target and begins to accelerate higher, you then begin to trail prior bars lows again, and so on. So it becomes a systematic method of management, and you just do that, and the odds are in your favor under this scenario because of everything that we've explained already. Target area, it's going to be based on some reference point of resistance over to the left, unless, of course, we are in a position that's making new all-time highs or new 52-week highs that are still within a price void. So whatever that target may be, it could be just based on prior swing and saying, well, this swing from here to here was 5 points, and so we're just going to look for like a measured move type of concept where that would be our target area to sell half or just trailing prior bars low when you're 80% way to that target. Or you sell another third and then just let it pivot again. We haven't talked about this particular concept, but one in which you might be using relative strength and relative weakness to where, as prices moved up You then you're reviewing what's happening, and as they're moving up, and you see a wide range bar at that point, and possibly the broader markets at that time had pulled back, and they're coming up to an area of resistance where odds are the markets are going to stall and begin to pull back, so you begin to tighten up stops. So there's different scenarios just based on the price action itself, or we could use the relative strength, relative weakness concept. Even one in which where the market has moved up as it has, and maybe your stock is sitting here at the prior swing high and it's shown relative weakness. So there are going to be methods of evaluating what's happening based on price as well as the concept of relative strength and relative weakness. A review on protective stops. Here's a start with a definition. The point where you've predetermined the probability of the trade working in the direction originally intended no longer exists. So you exit the trade. Simple. I thought something was going to happen based on our analysis. It's not happening. It's not what I expected would happen. An event happened that was unexpected. So I exit based on my calculated risk and stop loss. And that's going to be based on price. Meaning support or resistance is not a dollar stop to say, hey, I'm willing to risk $100 and I'm going to place this trade. And let's just look at an extreme here and say, hey, here's this stock that's trading at $340 and I'm going to risk $100 and take on 1,000 shares. Well, you're going to be stopped out probably in the next few minutes. And you can see why that's just not a smart thing to do. So once you've entered there based on the technicals, well, you've accepted what it is based on the chart and your reward to risk and your calculated stop and so on. So it's just one trade in many. And then we go into trail stop mode as just explained, where we're raising the stop after an accelerated move and or a pivot has formed and that's been established, and we go into trail stop mode. And as prices accelerate from a prior swing low for longs or a swing high for shorts, momentum is increasing, we then raise our stop above or below the prior bar. So the stops, we have to recognize them as being what's required to be in this business of trading. They protect our money. You have to recognize them as, I'll say, a friend here, because they're protecting our capital that keeps us in business and making more money, and just accepting the fact that the future is unknown. The odds are in our favor, and that if it doesn't work out, we step aside and we move on to the next trade. It's as simple as that. Danger of dollar counting. It's not your money until you exit the position. So don't be counting or spending unrealized dollars while in a trade. It's not what you should be focused on. What you need to focus on is the chart, bar by bar analysis, the way it's explained. And it really makes it rather simple as to what we're doing when we put together the concepts that we've talked about, where they come together and we see this opportunity that the odds are in our favor. We take our calculated risk, we enter at the appropriate time, and then see what happens next. We've got a plan. Our job is to stick to the plan. Why you might be focused on or thinking about the money? Scared dollars, which would be normal, to think about what's happening there and maybe not focused on there. Too big a position size. If you're thinking, what if? Well, you're never going to answer that question because no one knows the future. So why even ask the question, what if? There's no answer to it. If you bring yourself back to the concepts that we've talked about, and you're using that discipline and patience that you've acquired through experience and trading smaller positions, you're not going to ask that question. Well, what if you just don't have confidence because of a lack of knowledge? Well, you have the knowledge now, but that doesn't mean you really, let's say, know it, in quotes. Just because you've heard me explain it, that doesn't mean you know it. So maybe you need to listen to this again and again, and then go to your charting platform and look for examples and print out those charts or capture them in Microsoft OneNote and mark them up and do some audio recordings of your own, recording your thoughts and going back and reviewing what you've captured again. And through that practice, you will have the knowledge, and then you just have to experience it, not trusting that you'll do the right thing this time, meaning press the button and enter the trade, or take the stop loss. So being uncertain about your own actions obviously is not a good thing. And so with the answer to that, paper trading or very small position sizes where the money doesn't mean anything. So you can start out paper trading, you start out with small position sizes, and you build up again. And there may be a point in time where you run into a rough patch where the market becomes choppy or you take several losses in a row. Well, go back, and meaning smaller position size again, and reevaluate. You shouldn't stop trading, meaning you should always be selective in what you're looking for, of course, but there are points in time, as I said, the market gets erratic, or maybe you became overconfident and you started taking on positions that weren't part of your plan. So there are different variables that'll happen within the market that comes with experience, that you'll be able to adjust and recognize the things that you're doing yourself when you're not following your plan. Too large a position, well, that's an easy one, because when you start associating money management with psychology, all you need to do to recognize that is just put on a big position and watch how you start to worry, and get nervous. So the position size should be based on the money management, as already explained. Anything can happen. Always have two scenarios, which means here's my setup, here's my entry, here's my stop loss, here's my target, and the stop loss, having one already plans for the second scenario of the trade didn't work. So no matter how bullish or bearish it is, you're open to those other possibilities, because there are no guarantees. As much as we can put the odds in our favor, we never know 100% what could possibly happen. So why not consider other possibilities, even opposite of what the chart suggests? Why should you do that? Because it can happen. We don't want to confuse the matter by saying, the what if. But what if scenario is calculated into already what your stop loss. So it doesn't have to go any further than that. You've thought it through enough because you've already calculated your stop loss and you've put that in place. So, you move on from that. Overcome the temptation out of acting prior to information needed, out of fear of missing the trade. These are called impulse trades. How do you know you did an impulse trade? You go back and review your trades, and you come to the conclusion as you look at it, and you think to yourself, what did I see that made me press the button and do it? That's an impulse trade. Overcome the temptation out of fear that prices are going to move against you, rather than your plan as explained as to trail stopping, or maybe a big gap up in your favor where you're selling that position because of the gap. A market internal being at an area of resistance. Well, we haven't talked about internals yet, but you may be in a position where it's gone in your favor very well, and now the internals are warning, hey, there's risk for longs here, so tighten up your stop. But unless you have information to suggest that you should exit a position, that in of itself is an impulse exit of the trade. Now, patience and discipline will come in time as you apply the techniques that I've been teaching you here. And it is the biggest challenge because, as you've already heard, psychology is a huge part of what we do. And through money management and experience, you'll gain patience and discipline. And if you don't, you won't be doing this very long, because you'll probably incur some big losses if you're not applying, especially this section. And of course, taking trades that make sense based on what you've learned. You've got an objective method here. You've got some great information. Now it's up to you to make it your own. Advanced Money Management course delves into this much deeper. And as a swing trading student, I've provided you a coupon code, as you can see here on the slide, AMS Master. And if you apply that into the coupon code box that is there on the checkout, it'll take $300 off of the cost of advanced management strategies. Let's move on to the next section.